I'd like to welcome all of you to our March 12th AAI meeting, our main meeting. We've got a great program for you. It's a pleasure to have Janet Brown speak to us today. She's spoken to us many times and does a very excellent job of covering her area and what her newsletter provides. Some of the topics that will be covered: how to invest now when you don't know the future. That's always the case, but particularly at this point. How to avoid the worst investment mistakes and position for a variety of outcomes. And then how to balance your portfolio for stability in a low interest rate environment. Janet Brown is CFO and president of Fund X Investment Group, a San Francisco-based registered investment advisory since 1969. She runs, quote, the best performing momentum strategy over the long term, according to MarketWatch. Mark Albert has monitored her newsletter and rated it one of the few that will, on a consistent basis, will beat the market. For decades, her acclaimed upgrade strategies has helped investors use mutual funds and exchange traded funds to manage risk, navigate changing markets, and meet lifetime investment goals. NOLO Fund X manages separate accounts for individuals, retirement plans, and businesses. She publishes the NOLO Fund monthly newsletters that helps people upgrade and execute their strategies. So Janet, you have the floor, and appreciate your presenting to us today.
Thank you very much. I'm delighted to be here. And as you said, I welcome questions. If you can't hear or have a question, please jump in. There's certainly a lot to talk about with new information and change coming to us so quickly. We started this year looking at the end of a pandemic, the continuation of economic recovery, then Russia invaded Ukraine. A major war in Europe involving a nuclear power seems as if it belongs to another era. The general consensus is that things aren't going well for Putin, that his logistical planning was terrible, which sounds like good news for Ukraine with everyone around the world supporting democracy, right? But with Putin having no way of coming out in a favorable light, there are fears that he may escalate and act even more irrationally. This war is deeply disturbing on from multiple perspectives. And while the near term remains uncertain, the war is likely to have long-lasting economic and financial consequences. Most expect weaker European industrial production, higher commodity prices that could fuel the inflation phenomena already impacting global economies. And globally, commodity price increases place negative pressure on real growth. Inflation has been an ongoing concern. Higher prices are hurting consumer confidence. Tight labor market, higher energy prices also seem to be speeding up the Fed's reaction, but you know, they're still expected to raise rates this coming week, but certainly not as quickly as they probably were. And I'll go into, you know, some are worried about a recession already. All this uncertainty, and you're so right in the introduction, there's always uncertainty, but uncertainty can cause fears. And in uncertain times, it's important to have a plan, to know in advance how you will respond. So Fund X has a very logical, evidence-based approach that I think can be comforting when you know what to buy and when to sell. So today I'll be sharing some of what I've learned in the 40 years of studying funds and helping clients reach their goals. My hope is to be somewhat of a voice of reason to help you avoid making irrational or emotional investment decisions. So as I said, I'll start by quickly sharing how our firm developed over the years amidst the tremendous change in the industry. And then we'll look at the current environment. 2022 is shaping up to be a painful year for both stocks and bonds. The S&P 500 declined 11.5% through yesterday. And with the uncertainty about the long-term impact of the pandemic and now changes in the world economy, I do believe that the US economy coming out of the pandemic is different than it was going in. But I'll address some of the top investor concerns and share our views on how you can best position. Finally, I'll get to our thinking on our favorite alternative funds, which in this environment where we do not expect much gain from either fixed income and stocks are volatile, we think are a viable option. So this is an old picture of me with Burton Berry, the man that started our firm in 1969. And I'm really proud of the fact that Fundex started as a way to empower individual investors. When I started in this business, I was living in Europe and I saw mostly disadvantaged investors. And it became my mission to find a better way. After college, I was living in Brussels. I'd gotten a job in an American financial services company that was essentially selling mutual funds to servicemen overseas. So it didn't take me very long to figure out that the salesmen were making all the money and the investors were disadvantaged. Of course, in those days, there was very little information available. When I moved back to San Francisco, I met Burton Berry, and he had the notion of using no-load funds. At that time, there were about 120 of them, where there was no sales charge. You could essentially hire and fire the best managers in the country and be flexible, stay with those that were doing well, and what we called in those days upgrade when the original choices were not doing so well. So I've spent the last 40 years studying the industry. As you know, there are thousands of ETFs and funds these days, and the industry has really matured to the point where there's so much information available. In fact, so many choices, that's one of the confusing things, I think, to some investors. So today, I was incredibly lucky to join this pioneer at the forefront. And I really believe I was lucky to get in at the start of this individual investor revolution. After nearly 20 years of developing this strategy with Bert, I bought the firm and continued to grow it, started a series of mutual funds, and we continued to publish the newsletter that we started in the 70s. We also published, this slide is showing you something called Fundex Insights, which is free, and you could go on our website and sign up for that. The newsletter is by subscription. I'll show you parts of the newsletter today. Our upgrading strategy is designed to take advantage of major market trends, and the long-term results have been excellent. Here you see the performance of our growth portfolio is calculated by Hulbert Financial Digest. Hulbert dedicated his career really to vigorously tracking all the investment newsletters out there with real world performance results, so he would anonymously subscribe and track them and publish it. And so we're using his data here from 1980. And you'll see that by just blindly investing in our core growth funds over time, you would have outperformed the S&P 500 handsomely without having to forecast. So today's environment, the US, European Union and other global allies have broadly condemned the invasion and swiftly responded, aimed at crippling Russia's ability to maintain financial stability, cutting them off. Russia's quickly become the world's most sanctioned country, surpassing the likes of even Iran and North Korea. The current resurgence of solidarity among Western democracies, all sorts of things that seemed unrealistic until a week or so ago. Germans sudden rearmament, doubling their budget, Finland getting serious about joining NATO. And I guess 20 countries are now openly supplying weapons to Ukraine. Meanwhile, in the US, the Fed is set to raise rates for the first time since December 2018 next week. But now with commodities surging, the economy is already showing signs of slowing and stocks have been under pressure. Recession forecasts have been increasing even before the first rate hike. Some believe that the Fed has waited too long to start removing the COVID accommodation from the system. And now they've reached the point where they have to act no matter what impact their actions have. In addition to the Fed raising rates and the inflation backdrop, it's hard to envision any scenario that would be good for Treasury or long-term bonds in the near future. Even knowing all this, I believe the most important thing we can do is to be realistic and to focus on what we can control. This involves realizing what we can't control. No one can forecast the future. Things have a way of turning out very differently than any of us anticipate. So don't try and assume that you know what will happen. But we have to realize that things are what they are. We may wish they were different, that interest rates weren't going up, or that Putin had not invaded Ukraine, but they're not. So I believe the best we can do is to position ourselves based on what we can observe today and adjust as things change. Not based on what you think will happen, but what is actually happening. So back to our current environment. The good news in the US and other Western countries has been that the case counts from the Omicron wave and the COVID-19 collapse over the last couple of weeks. And now looks clear that the worst is behind us. As a result, and in conjunction with the widespread population immunity, restrictions are starting to be removed at a rapid rate around the world. The data continues to improve. It's important to remember that seasonality plays a part and cases could always rise again, but for now it looks like we're dealing with it. And certainly lockdowns, mask mandates, vaccine passports may be coming to an end. The stock market has been weak since the start of this year, and the downtrend has been pretty nasty. We're now 48 trading days removed from the S&P's record high on the first trading day of this year. And since then, the market has declined almost 12%. The S&P has been churning right around its support, with every rally in the last 2 or 3 months failing. And some of the more concerned technicians out there are starting to look over their shoulders at the pre-COVID highs, which are currently roughly about 20% below our current level. As I said, the Fed is set to raise rates for the first time since December 2018 next week. But with commodities surging, the economy already slowing and stocks under pressure, many believe that it will be a slower and more gradual increase. But as I said, it's hard to imagine any scenario that's good for fixed income going forward. The invasion of Ukraine led to a huge uptick in volatility across global markets and soaring commodity prices, whipsawing interest rates amid a broad sell-off in global equity markets. Part of the confusion stems from the upset of previously dominant narrative. While inflation is likely to accelerate further thanks to these historic rallies in oil, grains, and seed oils, financial conditions have tightened, and that's forcing caution on hawkish central banks. Russia and Ukraine account for about 29% of global wheat exports, and Russia's over 10% of global crude oil. I was listening to an expert yesterday that really thinks that food is going to be one of the major problems with 2.5 million refugees. It's a very worrisome environment. So in the US, all major averages, with the exception of the Russell 2000, fell more than 1% this week. The NASDAQ taking the brunt of the losses, falling more than 3.5%. Interestingly, since the war started on the 24th, most major averages are actually down less than 1% since the close on February 23rd. Year to date, the only major indices down less than 10% are the Dow, the mid-cap, S&P 400 mid-cap, and the small-cap indices. Energy continues to be the only sector with any positive momentum. It was up 2.1% this week, almost 14% since the war started. And it's up 38% year to date. At the other end of the spectrum, consumer staples plummeted nearly 6% this week. The performance of the international ETFs this week was a big surprise. The best performing country ETFs in our matrix were in Europe, which is the region of the world most impacted by the war. As anybody that's been watching the market knows, internationals and particularly emerging markets have been out of favor for much of the last decade. And it could just be valuations, but it was a surprise that Europe had a bounce. So forward looking towards recession, and I will caution you that there have been studies, there was one in 2014 by the International Monetary Fund that found that not one of the 49 recessions suffered around the world had been predicted by the consensus of economists a year earlier. And only 2 of 60 recessions in the 90s had been anticipated a year in advance. So that's not saying very much, but the market has actually shown a better record in predicting recessions. with signals strengthening as prices snowball. So among all the 20% drops that have hit American stocks since the Great Depression, all but 2 preceded or coincided with US recessions, according to Bloomberg. So today's environment in some ways reminds us of what happened in the 90s when Iraq's invasion of Kuwait fueled a similar spike in oil. Back then, the S&P 500 fell into bear market territory and the US entered a recession. So, as we've said a couple times, although this period may feel incredibly uncertain, there's always uncertainty, and the market has certainly dealt with similar situations countless times in the past. In my newsletter for March, I didn't put it in this presentation, but history definitely suggests that for long-term investors, the wise course is to stay invested and ride it out. When Iraq invaded Kuwait in '90, the S&P fell 18% and oil prices doubled, but stocks regained their losses before the war was even over. That was 6 weeks. And most experts are certainly expecting this to be a far longer conflict. After 9/11, the market took 11 days to hit bottom and 31 days to recover. And after the 2017 bombings in Syria, stocks bottomed out in 7 days and recovered in 18. As I said, though, Russia really seems willing to persist and even double down. So I'm going to turn to the mega trends that were already in place before COVID that have been accelerated, because additionally, many economists are saying that, Russia's economy is small. It really doesn't have much of an effect on ours. I do think that losing the peace dividend and the global economy ramping up into an entirely new stage will have a bigger effect, but the US economy won't be all that affected. And I think the US economy coming out of the pandemic is very different than the one that went in. All the cost saving measures in 2020, many will become permanent. Perhaps a third of all employees sent home to work will stay there forever. Workers who don't have to commute are happier and work cheaper. I love working from home. Our offices are open and we're getting some people back to the city, but most all firms, I think, are going to a split where people come in 2 or 3 days a week. So this is a huge cost saving. It could drop office expenses by half, which is a huge overhead for many firms. I don't think that commercial real estate is going to crash because of it, because I think growth will eventually fill the space in a year or two. And companies will sublease. Most of the big tech companies own their own office buildings in any case. Legacy banks the branches were cut in half, and those remaining are chronically understaffed, available by appointment only. These big banks have been trying to figure out how to unload expensive branch networks for years, and the pandemic just did it for them. Certainly business travel is now scarce, and that cost saving will be enormous. So costs are actually plunging and revenues are soaring. So the 3 big trends that we think are increasing, certainly more digital. The pandemic accelerated technology and the dominance of e-commerce at the expense of traditional retail. Technology was outperforming prior to the COVID crash, and it was hyper accelerated. I mean, just look at Zoom, a perfect example. Very few used it in 2019, except for maybe you guys in Silicon Valley, but most of the country didn't. And now it's a daily factor in most people's lives. Another effect of the pandemic has been to digitize the global economy far faster than anyone thought possible. Unlike a store accepting cash, you can't catch a virus from a digital transaction. So this is important, not just in this pandemic, but in the next one and the one after that. So I think that this exploding digitization, it started to lead, it's interesting, there's sort of a push-pull with globalization, because digitization sort of automatically leads to accelerated globalization, online businesses. I had a friend with a business in Australia who was kind of struggling to attract local interest, but suddenly his business doubled on an analysis of his subscriber addresses showed all the new customers came from China. So it turns out there's a lot of Chinese surfing the web to kill time as well. So the pandemic has really added fuel to some pre-existing trends. The pandemic has focused attention on underappreciated sustainability related factors too. And certainly supply chain resilience. So in the second piece, I'm going to be addressing more about sustainability, but the pandemic has certainly heightened the focus of inequalities within and across countries due to varying quality of public health infrastructure, access to health care. I think the market implications are, strategically, it's just wise to prefer sustainable assets among this growing societal preference for sustainability. Certainly, weather extremes, fire and drought are causing environmental disasters. The last couple of years were the hottest on record since modern temperature data collection began in 1880. The last decade was the hottest on record. This year's drought has become very worrisome. Ocean temperatures were the hottest ever recorded. And companies are feeling the heat too and scurrying to jump on the bandwagon. Larry Fink, the CEO of BlackRock, the largest money manager in the world, said BlackRock would begin divesting from investments that present high sustainability related risks. And in many ways, this is representing a real shift in how investors are viewing potential investing. The world is even shifting its thinking about the purpose of the corporation. A significant turn from the long-standing view that the primary purpose was to maximize shareholder value. The Business Roundtable said the purpose is to serve and create value for all stakeholders. I think that these cultural changes are very important in our investment world. So as I said, in the second presentation, I'll talk more about ESG investing, but for now, I think it's important to know that ESG investing is not proposing just being good for goodness sake. Instead, it's really a risk management tool and being used to enjoy better returns. The founding document, the ESG concept was popularized back in 2004 when the United Nations Secretary Kofi Annan invited financial institutions to develop guidelines and recommendations on how to better integrate environmental, social, and corporate governance issues. So the participants were Goldman Sachs, Credit Suisse, Morgan Stanley, Deutsche Bank, and the funding was provided by the Swiss government. So it was really a who of the global elite. And their goal, you can bet, was to manage risk. It wasn't just to make the world a better place or to be do-gooders. It's their founding document ended up being titled "Who Cares Wins." And I think that that's testament to how risk management using ESG can really help. So the current COVID crisis will elevate the importance of ESG to our clients. All major institutions have joined the movement. This is a quote from Citigroup. They created a division within its investment banking unit after the coronavirus pandemic, increased the importance of sustainability plans for corporations around the world. And they were joined by all their rivals. Barclays is, pretty much everybody's jumping on the bandwagon. Okay, so now I'm going to turn to the investor concerns and how we can solve them. This is what I'm hearing from clients. Even before the COVID crisis, there was concern and confusion. So it feels like a new level of disruption, but there's always something. So clients come to us because they're not sure they're doing the best job allocating and managing their money. Some tell us they just don't want to spend all the time pouring all the data, but mostly I hear concerns about the future, uncertainty. So I'll address those. News can lead investors to make emotional mistakes. Markets often react differently than most news pundits expect. Less than a quarter of major market movements are actually associated with big political or economic news. That's from Jeremy Siegel, the Wharton professor that wrote Stocks for the Long Term. Global markets are forward-looking indicators, but you simply can't make decisions based upon news or even know how markets will react. They turn out differently. So how do you invest without a crystal ball? Market predictions are typically all over the map, and you'll find very logical explanations of why the market will continue to go down. Other experts are saying it'll head it up. We hear opposing views from very well-informed people who are leaders in the field, and it's really easy to get caught up in these predictions. We instead, based upon evidence-based, what's actually doing well now. The traditional way that many large investors invest without a crystal ball is simply to cover all bases. That's a conventional approach that works well over many, many years. So that would be, for instance, holding both international and domestic, large and small, growth and value, in the thought that over long periods of time, every area will have its day and it'll all average out in the end. And it's true for long periods of times. However, it's quite easy to see in hindsight that different areas of the market come in and out of favor. The cycles tend to last long enough for us to take advantage of them. That means that the fixed asset allocators holding everything are suffering through these lagging areas of the market, trying to cover all their bases, and they're basically guaranteeing mediocrity. Instead, today, I'm going to show you, by focusing on what you know, which areas are doing well, you can keep your portfolio out of the worst areas. Overwhelmed by too many choices was the second most common thing I hear. And again, there are thousands of funds and ETFs to choose from today, far too many choices for most investors to handle on. I think the most important thing you can do is have a plan and know in advance when you're going to sell. It's pretty easy to know what to buy, but when are you going to sell? By having a plan, you can stay invested as well. Even with a diversified fund portfolio, it can be difficult to stay invested through these ups and downs of the market. It's often harder to stay the course with aggressive funds. Some people just have to make a move, and I'm going to show you how dialing down the risk may be a way for you to stay invested. Again, focus on what you know. The first thing is to be realistic, realize things are what they are, and go with it. So we have a 3-step process. First, take all the funds in the universe and sort them by risk. We literally keep databases of all the funds and narrow it down to a universe of funds that we would actually buy while they're doing well. And then we categorize them by risk. I think it's very important to get a handle on the risk. And then we simply rank and sort these funds by what we consider current performance. And that is an average of the 1, 3, 6, and 12-month total returns of each of the funds. This is the back page of our newsletter. You can see this is the March issue, and it's kind of at a glance what's doing well in the various categories. Class 1 are the aggressive funds, and I can show you more detail of each class. But generally, the back page gives you a snapshot of the 3 equity classes. Class 4 is a total return balanced class. So what's working now? This is class 1 and 2. And you can see in class 1, it's all energy and natural resource funds. You'll notice that we mix exchange traded funds right in with other 40 Act funds. Exchange traded funds are 40 Act funds, but as you know, they trade like stocks. The most value I can give you today is really to share with you, after studying funds for 40 years, what we've landed on are the best ways to use funds and ETFs. We mix them together. We do not have a preference for actively managed or passive. When passive are doing well, they're lower cost, we're fine to invest in. There are great tax advantages to exchange traded funds. ETFs, as probably many of you know after last year was a tough year for distributions from open-ended funds because there were many gains that had accumulated from 2020. And in 2021, there were several rotations from value to growth and back and forth. There were actually 4 different rotations when the market kind of whipsawed people around. So most mutual funds realized gains, and then because of their very nature, open-ended 40 Act funds are required to distribute most of those capital gains, whereas ETFs are not. Because of the creation redemption process with ETFs, they can avoid distributing those gains. So that's one huge advantage. of exchange traded funds. Years ago, in fact, we were too early to the game. About 15 years ago, we had mutual funds that were ETF only, and they just hadn't become as popular as they were now. And we ended up merging them into our other funds. But more and more for taxable accounts, for tax deferred accounts, and I assume that you, the audience, like most of our clients, probably have tax deferred accounts as well as taxable accounts. And in your tax deferred accounts, as you know, you can be quite free to be flexible and invest in actively managed, but more and more in taxable accounts, we're using exchange traded funds. And of course, there are more and more every day. So long-winded way to emphasize that we're agnostic. We don't really care if it's an ETF or an exchange traded fund. Of course, we have traders that do the trading for our clients and our mutual funds. If you're doing it on your own, of course, you want to be very alert to the liquidity and the tradability of these ETFs, and so you don't get hit with too wide of a spread. In our newsletter, we only include exchange traded funds that are quite liquid and have good trading. So that's all you'll see in our listings here. And what's working now in class 2 and 3? So class 2 are still aggressive funds, but they're diversified. You can see at the top of the ranks as of the end of February was Hennessy Small Cap Financials. Financials usually do well when interest rates go up. The other funds that are at the top of the ranks in class 2 are all value funds. You probably know that we have been in a long-term growth trend when the highest growth companies, including large cap, mostly tech, has been doing extremely well. But now we're seeing funds like Invesco High Yield Equity Dividend, PEY, Fidelity Value Strategies, American Beacon Small Cap Value, Vanguard Small Cap Value, VBR, Price Low Price Stock. A lot of small cap dividend and value, even the small cap 600 value index, IJS is there. And then we're seeing names that always come up in the value period. In class 3, Moolenkamp is a actively managed 40 Act fund that we've used in very successfully in value periods. And it does seem like we're entering a value period. Certainly now at the top of the ranks, you'll see RPV, Invesco's S&P Pure Value Fund, Core High Dividend Funds, DVY, HDV, and then funds like Vanguard Windsor, Price Equity Income, Fidelity Value, Fidelity Equity Dividend Income, Vanguard Equity Income. So this is what's at the top of the ranks right now. The monthly upgrader portfolio is on page 2 of our newsletter, and we put it in there really to give you an idea of how we're managing our separately managed accounts. So you can get a look at what we're doing. You'll see that we have about 10% of this growth portfolio. This portfolio is only for growth. That is in the aggressive class 1 funds. They're aggressive because they're sector funds for the most part. They're concentrated. So you see we own mostly energy and natural resources there, the top ranks. In class 2, mostly value funds and small cap financial. SPHQ is the Invesco S Quality Dividend. Oakmark, the Oakmark family is another value family that traditionally has done very well during these value periods. And then there's a sustainable fund, Tax US Sustainable Economies. But you'll note that we have 70% of this growth portfolio in the core holdings, what we call class 3. And these are funds that have a risk about what the broad market does. They're the most diversified. And after testing this for, nearly 50 years, we've found that our particular strategy of upgrading does best with the majority in these more diversified core funds. Our strategy is not really an active trading strategy. It's more to manage risk and capture the long-term trends. So 40% here has had the best returns with all of our backtesting. Here again in class 3, you're seeing a lot of value funds right now. Muhlenkamp and Oakmark that I already mentioned. iShares Core High Dividend Fund, HDV, Invesco Pure Value, Fidelity Value. So you can go online or look at our newsletter and see what we're actually doing in our managed.
Janet, Janet, there's a question, if
Sure.
you don't mind being interrupted. Is this newsletter only for Fundex clients, or can anyone subscribe to it? Any fees? How to subscribe?
Yeah, it's available to anybody. It is by subscription. We have a special for the AAII members, and I'll show you at the end. I think the cover price of the newsletter is $179. I should know that off the top, and I don't. That's not my area, but I think we offer a special for AAII, and it is available to anybody. So by following this monthly upgrader portfolio, here's showing you the performance. Again, just blindly investing in those funds versus the S&P 500. That's just for the last 21 years. So in essence, what I'm telling you with what we do in the newsletter is just accepting the market's trends, whether we understand the reasons for them or not, invest on what is happening, not that what we think will happen. Secondly, being alert to changes. We know that the market's going to change. And by looking at the newsletter monthly, or you can go on our website, you can also just subscribe to Fundex Insights and see what we're doing. I think having a system really does prevent you from changing directions impulsively. Having a discipline that's very quantitative like ours leads us to a new trend as it's being confirmed. We move incrementally because, of course, the market moves in fits and starts, and you need to have a smoothing effect. So what our formula does is smooth out the bumps a little bit to identify the long-term trends. Sell-offs are a big dread. Market declines are normal market action, and we think everybody's plan should include an expectation of several 10% sell-offs and at least one 15 to 30% sell-off correction in the next 3 to 5 years. So even though market volatility is unsettling, historically it's not unusual. So you need to build an appropriately diversified portfolio to match your time horizon. It can be hard to do nothing, but we really don't think you should try and time the markets. Build a diversified portfolio based upon your tolerance for risk and build in protection. So just to show you what the calendar year sell-offs have been, this chart is showing you each calendar year return in blue and the greatest intra-year decline in red. So you can see in 21, the market ended up 29%. It just had 5% sell-off. But you can also see that over time, most years have declines greater than 5%. There's several 10%, 20%. Of course, you can see here in 2008, down 48%, in 20, down 34%. So volatility is normal, and plan for it. Again, we think that you should stay invested. You've probably seen the charts before about missing the best 10 days and the best 25 days. My important point here is to build your portfolio in a diversified way so you can stay invested. The traditional way of doing that was to balance between stocks and bonds. And I've taken too long, I'm afraid, talking about the war and the economic backdrop. I'm going to quickly show you our fixed income strategy, because we don't have a traditional fixed income strategy. Instead, we approach fixed income like equities, because just as with stock, bond markets change. So we seek steadier returns by diversifying into 5 different buckets and actively managing these buckets. In the newsletter, I showed you our growth portfolio. So this now is our fixed income portfolio. And last month, we sold all of our high yield funds and bought basically TIPS. American Century short duration inflation protected bond, iShares 0 to 5 year TIPS bond, PIMCO 1 to 5 year US TIPS. So this is a very actively managed portfolio. I will send you all copies of this so you can have it, but I'm going to go pretty quickly and explain. Here you can see that the portfolios change pretty actively. When we're opportunistic, we're going to go a little longer term. Cautious stance, we could be entirely short term or intermediate term. In 2014, we went back to diversity, but in a rising interest rate environment, we're getting very defensive. So our flexible income approach really does react to changing markets, and it's been successful. I don't know if you can read at the bottom of this, but I put this portfolio in the newsletter back in 2005, and the annualized return since then is 4.7% compared to the aggregate bond index of 3.7. So just like with equities, you can increase your returns by positioning with what's working in the current market environment. I'm not going to spend time on this. This shows you that high yields, when we're led to them, when we're not. So with interest rates going up, we're seeing a rare combination of surging prices now with the war and a constricting economy. So history has shown that an outright inversion of the yield curve signals an imminent contraction. When it's just the yield curve narrowing or oil jumping or stocks falling into correction, maybe you could hold off on panicking over a recession. But when all 3 are happening at once, the argument gets stronger that it's time to take this threat seriously. This may seem like a misplaced concern when the US economy has just generated almost 700,000 jobs in a single month. And few observers really see a downturn in the immediate future. Nevertheless, markets are forward-looking, and the common message is getting harder to overlook. The S&P 500 sank almost 3% Monday when oil approached the highest price in a decade, and commodities are surging. So the message suggests the threat of an economic retrenchment has certainly increased amid the war in Europe. So what can we do about it? One thing I think we can really do is be clear about our return expectations and think beyond the classical 60-40 that was traditional. What we're doing with our client accounts is investing in alternative funds. Stocks and bonds usually don't move in sync, but typically when stocks fall, bonds are the anchor. But again, we do not expect gains from bonds coming forward, and stocks are very volatile. So alternatives are, we think, a good solution to ride out these periods. Alternatives is a broad category of funds that invest outside of traditional stocks and bond buckets. In most of our client accounts, we're taking at least half of the fixed income and in some cases, a good chunk away from equities too, and putting them in these alternatives. So as the name implies, these funds are designed to be alternatives to stocks and bonds. They own a variety of things, including possibly real estate or currencies. Many of the funds use hedge fund style strategies, such as long, short, merger arbitrage strategies. The main thing is they provide additional diversification, potentially some growth, even in periods when stocks and bonds are both flat. Their volatility is far more similar to bonds than it is stocks. You can read here what we think the benefits of diversification with alternatives are. We've had terrific returns to US stocks over the last decade. And in a new regime of lower return and higher risk, these alternative funds, we think, can offer some stability. There are different objectives for hedge funds, hedging, diversifying, or modifying portfolio. I just put in an example of my 15 favorite alternative funds. We do not measure alternative funds with the same formula. Some of these funds are mixed in our newsletter, many are not. We really measure these funds by a Sharpe ratio. The Sharpe ratio takes into account both risk and return. It was developed by a Nobel laureate, Bill Sharpe, and it's used to help investors understand the return of an investment compared to its risk. So the ratio is the average return earned in excess of a risk-free rate for the volatility. So these are my favorite alternative funds now, and I'll show you how they've done. I use Fast Track and I made a few charts. What you're looking at here is SPY, the S&P 500 in the blue over the last 3 years, and bonds as represented by the Barclays Aggregate Bond Index is in the green. And my 10 best alternatives based on Sharpe ratio is in the red. So for this 3-year period, and it's right up to date, I think through Thursday night, actually. I made this chart. SPY averaged 17.7. Again, it's just an average of 10 alternative funds in the red, but they averaged 8.6% and bonds averaged 2.5. It all depends on what period you're looking at. So now you can see a 2-year period, but when the market declines, alternatives add value. During this period, you know, SPY was far ahead with 23%, but the alts, we started getting really interested in them when it was clear, you know, we've all been expecting interest rates to go up for, you know, the last 5 or even 10 years, but it finally started to happen. And so fixed income for this 2-year period is actually in the negative. The ag is minus 1.6. And for the 1-year period, you can see that the aggregate bond index is now down 4%. Alts, healthy 8%. And again, it's a combination of funds that some are using hedging techniques like long short. Some are investing in a multiple group of funds. I'm afraid I have gone long. I put in some financial planning things here because I think that's probably the most important thing we do for our clients, is really help them zero in on what risk is appropriate for them, how much risk they need to take. None of us like to take risks probably, but we need to have the growth necessary to grow our portfolios. So these are some of the things we offer our clients.
There is a question in the chat about, are we looking towards an inverted yield curve?
Many people think we are, and I can go back to that slide there. You know, it's a rare combination of surging prices. Stagflation is surging prices in a conflicting economy. 10-year inflation break-evens just increased to the highest level since 2005, while the yield curve, which is the spread of the 10-year over the 2-year treasury, narrowed to levels not seen since the pandemic recession. And when it's just the yield curve narrowing, it might be okay, but there is concern. Again, you know, I'm not an economist and I don't know, but I think it's important to watch these things and be alert to them. And certainly I put in the section on alternatives because I think that in a high risk environment, rather than bonds, I mean, it's just, nobody thinks that treasuries are going to be a good place to be going forward. So we've got to be realistic. We can't foretell the future, but we can position ourselves based on what we can observe today and accept these markets trends. So I think that's about the best we can do, is stay alert to what's happening. Position yourself for a variety of outcomes. You know, we all make mistakes, every investor do, but just be careful to limit the damage. Ideally build safeguards into your strategy that automatically limit the damage. And I think, again, that's probably one of the greatest values of having a plan. Many plans work, not only our system, but many do, but you've got to stick with it and have a discipline. Realize that things are what they are. You may wish they were different, but they're not, so you have to continually adjust. So this is a slide showing you insights for active investors, which you can sign up for free. We've had awards for our communication. Here's a screenshot of our website, and I actually had a link where I could put in the chat. Maybe I'll do that during the break to not take time now, because I see that it's after 10. But if you want to go to fundex.com, you can see sign up for Fundex Insights. If you do, I didn't put screenshots of our website in here, but our website has something called Fundex Interactive. So if you're looking to streamline your investing, we have an online database that can help you quickly find and track your funds. You can use Fundex Interactive to look up a fund by its ticker symbol. You can create ranks of only ETFs or no ETFs. The funds are listed in rank order. You can rank them by our ranking system. You can also create a portfolio of funds you own. For instance, if you have a retirement plan at Vanguard or Fidelity, you can sort by all the Vanguard or Fidelity funds and get their current ranking. It's a way to set up a watch list of funds that you might consider owning and stay on top of their performance. We do like to talk to subscribers and clients, as we're a small San Francisco-based local firm, although we just completed a merger with a larger firm called One Capital Management in Southern California. We will retain our office just as it has been, with the same people, and all the investment managers in my office will be staying there. We have 5 different managers and staff of 15 in San Francisco. So if you have questions, you're welcome to call the office. We're patched through to our home offices if we're not there, and we're more than happy to answer questions, guide you through the newsletter, or tell you about our individual management and our financial planning services. So with that, I will see if there are any questions.
Yeah, I think we've answered all the questions that came online. So why don't we take a 10-minute break, and then we'll start up again at 20 after 10 with the sustainability presentation.